jump into equities because our 2025 theme for equities is that they were overvalued when we started in January. We wanted and needed to see a correction. We thought it would be led by tech, and that's what we got, right? So, and it turned out to be a much scarier correction than I think we wanted in January. But here we are in May, essentially halfway through the year almost, and our 2025 theme of the market being overvalued and a correction led by tech has happened. We also felt that we would be in an extended period of time of stagflation, and that sectors that perform best during stagflation would be the things that this year would perform best. That is happening. I'm going to show you that in the charts. I'm going to show you, if you want to get in the equity market, an approach that I'm taking for clients. So here's the S&P 500 from 2009 to 2025. We showed this to people in April when we talked about what to watch for in April. The dark green line here is what we call the reversion to the mean. This is the long time support of the market. And that some point, well, the way markets work is, you could get a big enough correction to take you all the way back to that mean and still be in a 20-year bull market. And so that's a long ways down, and we don't want to experience that, but it's possible. So what we did is in April, we said, hey, here, this line that started in 2023, this green dotted line is a line of support of the current rally that started in 2023. And that dotted line is basically what I call the bull bear line. Right. So is intermediate support, and that's basically supporting the rally that started in this market in 2023. And trading above the line means you buy the dips. Trading below the line means you sell the rips. So essentially what I did here is I tightened up the chart to be the last 3 years rather than the last 10. And now you only have the dotted line, which is that bull bear line. This is that intermediate trend line that started in 2023. I'm calling it the bull bear line, saying that if we're above that line, the market rally that started in 2023 is still intact. And so the rule book says buy the dips. If you break below that line, which we almost did in April, we kind of whipsawed it, which is normal behavior for a correction. So we whipsawed it. And what we're watching for in the future is if we ever have sustained trade, multiple days, week, 2 weeks below that dotted line, then the bull trend is broken. And at that point, what you do is you sell the rips, not buy the dips. So far, what happened in April is we came to the line and the bulls stick saved this baby. I mean, just right when they needed to. And since then, what we were looking at and said would be the early tell was this red dotted line, which was resistance. And we wanted to see if we could get above resistance and see if the relative strength would start to become more constructive. So here's what's happened since is, 2 weeks ago, May 2nd, we gave you this updated chart. You got the bull bear line. We had this line of resistance that we had just popped over. Okay. Just got over that. And our question was 2 weeks ago was, will that resistance now become support? And it did. Here, I'm going to show you this. This is the tell. Well, yes, is the tell is, will we hold support? And will this RSI continue to get stronger? Well, we held support. So there's the bull bear line again. There's our resistance. We came and this is where we were 2 weeks ago, right here. So we took that first Monday, Tuesday of 2 weeks ago, and the market pulled back, and that now did become support. You can see it held it. Very little minor. It probably needs another test. And then the rest of the week, it just kind of meandered sideways. And then on Monday, boom, we got a pop above. And so now have sustained trade above what used to be resistance. So now we've got to consider it support. And basically what's caused it is these two little tariff pauses. So you had the first tariff pause, and then you have the second. Now, what's interesting here that you need to realize that is a word of caution And the thing that makes me go, is that one, this rally's pretty parabolic. This looks like a short squeeze. It doesn't look like new money coming in. This doesn't look like long-term investors, piling in here. Because that usually has a different look, but this does have a lot of short covering. So what we really need to see next is on the next correction, because we're really overbought here. When the RSI starts to get up into that 70, 80 range, then you're overbought. Whereas when it was down here at negative 20 or at 20, that you're oversold. So now we're in a situation that we need the market to work some of this off. And that's going to be the next tell. The next tell will be, do we get a little bit of a correction next week? What I'd love to see would be really a confidence builder would be that the market corrects back down to that 5,600 level and it holds again, because then you'd have two tests and this second one would be even more significant. And so what I would love to see is can the market correct back down to 5,600, RSI come down, maybe finish dropping at 50 and turn back up. If I start to see those things, then the confidence of the bull market continuing should increase, right? So those are the things that I'm going to watch for. Does that on the next pullback, if we get a pullback, and I think we will, on the next pullback, where does it stop? Where does it find support? And what happens with the relative strength? Because that will tell me whether the rest of 2025 you can stay in the market, or do you have to start to hedge or reduce exposure? So one of the other things I showed you 2 weeks ago is that there was green shoots. And I had showed you that a handful of the MAG 7 had gotten above resistance. And what I wanted to see over the next week or two is, could the rest of the MAG 7 get above resistance? What is resistance? Like, for instance, here on Amazon, it's this little red dotted line. On Google right here. So as of the time that I asked this, there's quite a few of these, basically Apple, Google, Amazon, Tesla, and NVIDIA had not gotten above their resistance. Now they have. Out of all of these, only Apple and Google have not gotten above their resistance. So that's a really good sign. I mean, basically 5 out of the MAG 7 have gotten above resistance. Now the tell is, does it stick? And on the next pullback, does it create a buying opportunity? So the other area I want to, because for the Quiver clients, what we did as the market has done this is we have added to our tech holdings. We've added to the ASMLs, the Amazon, the Google, those things. We also, while we were doing that, we looked at the market, and what's amazing is if you look throughout the year, even during the April sell-off, the stagflation names, like utilities that I just popped up here on the chart, continue to have the strongest relative strength. So utilities, you can see, are still trading at the high end of their range over the last year. And even the April sell-off was pretty muted for compared to what happened in tech. So you have a situation where, utilities are still positive for the year and most of tech is still negative. And you have the same thing here when it comes to aerospace and defense. Now, this is aerospace and defense. If you look at this chart, this last run up, a lot of this is that Saudi deal. So in the beginning, I mentioned to you what sector benefited the most. It's aerospace and defense. If you look at a chart of Boeing, you see the same jack up, right? So basically, Boeing got such a big order from the Saudis that it pulled the rest of the aerospace and defense sector up. I tell you right now, as an investor, if you're bullish, like if you're really bullish the market, you don't want utilities in aerospace and defense leading it. That's usually not a sign of a healthy economy. These are the sectors that lead when people are more defensive. And then this last one I'm showing you that's had good relative strength this year and is a stagflation name is the basic materials, or what you would call consumer staples, not basic materials, excuse me, consumer staples. And so consumer staples is all the stuff you need that you just basically can't live without. And so when you have utilities, aerospace and defense, and consumer staples leading the market That's not what you see typically in a new start to a bull market. Like if you think about in 2023 when this bull market started, the leading sectors were the Mag 7. It was the tech names, the small caps. It was all that stuff started first. And now as it's matured, you're getting these sectors as your leaders. So that should be a tell. That should tell you, if you're a prudent investor, that you need to tread in equities cautiously because the professionals are. The market's telling you what's leading. So what does this mean to you? Like if you're a Quiver client, if you're an investor managing your own portfolio, well, what can you do with this? Well, what it means is that the market recovery that we've had is really encouraging. It's exactly what we wanted to see. Now on the next correction, we want to see if 5,600 holds because that's important. And in the event that it doesn't, the next tell would be 5,400. A break below 5,400 with an impulsive decline, a 5-wave decline, would really open the door for new lows. Right now, there's no sign of that. The bulls have the ball right now. The bears really, have the work cut out for them if they're going to turn this market back down. So next week will be a really important tell for the overall market of equities as well as interest rates. So it's really, really interesting how they're all correlating as far as their inflection points. I think most likely the rest of 2025, you're probably stuck in a range in the market. So if you're an investor, realize if this market gets stuck in a range, or even if it does have new highs in front of it, how much higher can it go? Because if the market prices are a reflection of earnings are probably not going to get multiple expansion right now in this environment. And earnings were already slowing down going into this quarter. And the last quarter was good, but earnings look at the past. And what we're looking at the future is that earnings should be slower. And I don't think that the current levels of the market price that in. So I wouldn't be shocked to see the stock market kind of stay in a range here, that maybe, 56, like 5,900 on the high end, 6,000 down to 54, and you play around there for a few months. So what you can do if you want to be a prudent, take a prudent approach to investing. And one thing that I'm doing for some clients is I'm taking this barbell approach. And the barbell approach is essentially on one side of your investment thesis, you buy the beaten up names, the stuff that's in tech, right? Some of the Mag 7, whatever other names you like. Then realize that if the market were to really go back down, those names are probably going to get beat up the most. So buy those in small amounts, be willing to buy more later. And then on the other side of the barbell, put the stagflation names, the names that have had the strongest relative strength so far this year: the utility sector, the consumer staples, the aerospace and stuff. Aerospace and defense, I wouldn't buy right now. I'd cool your heels on that until let it come down a little bit. But Quiver clients will notice that now in the portfolio, some of our bigger weightings is utilities and consumer goods, in addition to some of the tech names that we have. So you can already see that in the Quiver portfolios, we've already taken this barbell approach, and we started that earlier this year. And then we're building on it as the market has given us opportunities. So that's one way to consider approaching this market and putting some money to work. And hopefully you won't get your ass handed to you if the market does happen to pull back. So I would highly suggest that everybody go back to one of our March events or our March videos, the Stagflation Playbook, because we gave you each sector, the levels to watch, everything in that. I'll do an update in the next couple of weeks, as it does look like stagflation is going to be the winner for this year, especially if we continue with this tariff stuff. So let's wrap it up with